Imagine walking into your favorite taco restaurant. You sit down, you pick up the menu, and you start looking through all the familiar choices: chicken, beef, steak, fish, carnitas. I love carnitas. Everything looks great. Then your server comes over and leans in and quietly says to you, "Would you like to see the secret menu?" Suddenly, everything changes. The best items aren't even printed on the menu. The most unique combinations, the chef specials, the dishes that everybody talks about are reserved for those who know where to look. Investing, it works the same way. Most people spend their entire lives looking at the public menu: stocks, ETFs, mutual funds, bonds, all excellent investments. And we've spent the past several Taco Tuesdays learning exactly how they all work. But beyond the public markets, there's another world, a world where institutional investors, family offices, endowments, pension funds, and many sophisticated investors explore opportunities across a broad range of private and alternative asset classes: private equity, private credit, venture capital, commercial real estate, infrastructure, life settlements, and much more. Today, we're opening up the kitchen doors and taking you behind the scenes. Welcome to Wall Street's secret menu. Welcome back, everyone. I'm Donald Johns, and this is another episode of Taco Tuesday on the Unbearably Bullish Podcast, the official podcast of the Bull You Can't Bear. This is the show where we take complex financial concepts, break them down, serve them with a little creativity, and hopefully make investing a little easier to understand, one taco at a time. Whether you're just beginning your investment journey or you've spent years building wealth, our goal is simple: to educate, to simplify, to challenge conventional thinking, and to help you become a more informed investor. Because here we believe in strong markets, stronger mindset, unlimited opportunity. So grab your favorite tacos and your favorite beverage, and let's order something that's not on the regular menu. Let's talk about the shell. What are alternative investments? Because every great taco we know needs a strong foundation. When most people think about investing, they usually think about three things: stocks, bonds, and cash. These are often referred to as traditional investments because they've historically formed the core of many investment portfolios, but they're only part of a much larger investment universe. Everything outside of those traditional categories is often grouped under a broad term called alternative investments. Alternative investments encompass a wide variety of asset classes and strategies that may behave differently than traditional publicly traded securities. Examples include private equity, venture capital, private credit, commercial real estate, infrastructure, farmland, timberland, precious metals, energy projects, collectibles, life settlements, and many others. Now, here's something important to understand. Alternative investments are not inherently better than traditional investments. They're just simply different. Different objectives, different structures, different risks, difference of liquidity characteristics, different return drivers. Understanding those differences is one of the keys to becoming a more informed investor. Let's talk about the meat, baby. Public markets versus private markets. I'm going to build today's taco. Imagine you want to invest in a company like Apple or Microsoft. You simply log into your brokerage account, you buy the shares, and seconds later, voila, you're an owner. That's the public market. It's transparent, it's accessible, it's highly liquid. Prices change every second the market's open. Now imagine a growing technology company, a manufacturing business, or a healthcare company that isn't publicly traded. Its ownership isn't bought and sold on a stock exchange. Instead, capital is raised privately through investors who are willing to commit money for longer periods while their business grows. That's the private market. Private investments often have different structures, long investment horizons, and different liquidity characteristics than publicly traded investments. They're, they're generally less transparent because they aren't subject to the same continuous public reporting requirements as companies listed on national securities exchanges. That doesn't automatically make them more risky or less risky. It simply means they're different. Different opportunities, different challenges, different considerations. One isn't universally better than the other. Each serves different purposes depending on an investor's objectives, time horizon, liquidity needs, and tolerance for risk. Let's get into the cheese, baby. Why do alternative investments exist? Well, here's a question I hear all the time. If stocks and bonds already exist, why do alternative investments exist? Well, that's a great question. The answer comes down to one word: choice. Different investors pursue different objectives. Some prioritize long-term capital appreciation. Others focus on current income. Some seek diversification. Others are looking for exposure to sectors or business models that aren't readily available through public markets. Institutions such as pension plans, university endowments, charitable foundations, and family offices often evaluate a broad range of investment opportunities across both public and private markets. That doesn't mean every investor should own alternative investments, folks. It simply illustrates that the investment universe extends far beyond the assets most people see every day. Understanding those choices is an important part of financial education because the more you understand what's available, the better prepared you are to ask informed questions and evaluate opportunities in the future. Let's talk about the salsa, the secret ingredient: diversification. One of the most common concepts that are discussed in investing is diversification. You've probably heard the phrase, don't put all your eggs in one basket. That's diversification in its simplest form. The idea is that different investments may respond differently to changing economic conditions, interest rates, inflation, market cycles, or industry specific events. Because of that, many professional portfolio managers evaluate a mix of asset classes rather than relying on a single investment type. It's important to remember, however, that diversification does not guarantee a profit or protect against loss. Markets can decline, and many asset classes may experience losses at the same time. Diversification is a risk management concept, not a guarantee. Understanding that distinction is one of the most valuable lessons an investor can learn. When we come back to part two, we're stepping into the chef's kitchen, where we're going to take a deep dive into private equity, venture capital, private credit, and why many institutional investors devote significant time to understanding these parts of the investment landscape. Then we'll head into the real estate section and the secret menu, where we're going to explore private real estate, 1031 Delaware Statutory Trusts or DSTs, and other real estate alternatives. The kitchen is just getting warmed up, folks, and trust me, the chef's specials are still to come. We'll be right back.